Peter Lynch is one of the most legendary investors of all time. And this spreadsheet brings you one step closer to investing like him. Peter's famous for managing Fidelity's Magellan Fund from 1977 to 1990. Under his 13-year management, the fund earned an annualized return of 29.2%, more than doubling the S&P 500's performance for that period. In his book, One Up on Wall Street, he describes a simple valuation formula anyone can use to value stocks and determine if they are selling at a good or a bad price. In this video, I will share with you what the formula is, why it works, and most importantly, how you can use it to make some great investment decisions for yourself. At the end of the video, you will be able to just enter a ticker like this and you will see if the company is overvalued or undervalued right away. But the question is, what is the formula? The formula is simple. You take the future growth EPS plus the current dividend yield for that company, and then you divide that number by the current PE ratio. Depending on the result, you can see if a company is undervalued or overvalued. This formula works because it prevents you from paying too much for a particular company. To set up your formula, all you need to do is set up the company ticker like this. In this case, we're gonna use Apple. Then in the spreadsheet, you need to enter the future EPS growth, the dividend yield, and the PE ratio of the company that you're analyzing. For this, you can use Yahoo Finance and copy paste all the information for every company that you analyze like this. Or you can use the Y-Sheets add-on to get the data automatically like this with the following formulas. Then you need to apply the formula to the data. Remember, you take the sum of the yield and the future EPS growth and then divide it by the PE ratio. Now here's the key. If a company has a number less than 1, this is considered overvalued. Between 1 and 1.5, this is fairly valued. Close to 2 would be undervalued, and then close to 3 would be the ideal scenario where you're looking at a company that is very undervalued. You can apply this formula that you're looking at right now so that the assessment that you can see right here can be done automatically for you. This works because according to Lynch's valuation approach, a fairly valued company will have a PE ratio equal to its growth rate and the dividend yield that it currently pays. In other words, a price to earnings growth ratio of 1. For example, if a company has earnings that are expected to grow at 15% per year and the company doesn't pay a dividend, a PE of 15 would be considered a fair deal. Once you have your template ready, you can change the company ticker and voila, you can value stocks like Peter Lynch. Now the key question is, does the Peter Lynch formula actually work? I was able to backtest only for 1 year, but the results were actually pretty good. You can see in this case how you're pretty close to the market return and can perform even better in longer time frames. However, for every stock that you analyze, I recommend that you do other types of valuation methods, such as a DCF, a dividend discount model, earnings power value model, etc. There you go. Now you can use the Peter Lynch formula to find great investment opportunities faster, get bragging rights amongst your friends, but most importantly, build wealth for yourself and for your family. I'll see you in the next one.